Jeff, happy Friday. Good to see you.
Thanks for having me on. Great to see you, Carl.
So a lot of moving pieces. Obviously, the COVID element, D.C., as this bill gets back to the Senate now, does include a lot of things like a minimum corporate tax and a stock buyback surcharge. What do you think we need to be focusing on right now?
Well, none of those things are too surprising to the markets. I do think that we can't forget about COVID. Look, well, obviously what's going on in Austria is a little bit of a surprise to see that much of a lockdown. But, you know, what we're seeing is COVID evolve from being a pandemic to endemic. And this might be something that we continue to see over the course of the winter. And while Europe has a lower threshold for restrictions amid early signs of a seasonal surge, the U.S. could be more vulnerable over a full winter due to the lower vaccination rate.
So that's a sort of the dark view, Jeff, is that a wave of COVID would impede consumer mobility and consumer spending. Meantime, you could have continued bottlenecks in supply chain, higher prices, and that would give sort of a whiff of stagflation. If we got there, would that be a viable dip or not?
I think it would be a viable dip. I think as we look into next year, we're more likely to see some of these shortages turn into gluts. We've seen a long history of shortages become gluts. Even last year with things like disposable gloves, we saw disposable glove makers' stocks soar and then come right back down again towards the end of the year. So we know this is a common thing that happens, and that will be very likely, I think, in the second half of next year. So I think that surge would be temporary, and it would likely be a viable dip.
All right. So that said, what is on your shopping list at this point? Are yields moving in a direction where you look to financials? Is COVID moving in a direction where you look to travel and leisure? Where's your priority list?
You know, I think the problem with, I'd love to say financials make sense here on a steepening yield curve and higher longer term interest rates as we look out to next year. And that may still be the case longer term. But in the near term, we've got this uncertainty around FOMC membership. Not only its leadership, but its membership. For investors, this is like stacking the Supreme Court. Fed terms are for 14 years. That's like half a generation. And President Biden has the chance to stack the Fed here with so many open governorships. And I think if he started with making Brainerd chair, the market may price in a slate of other progressive nominees. And then investors could see Biden looking to placate the progressive end of his party. And that might mean a sell-off in longer-term bonds that might steepen the yield curve. But the potential to bank regulation may keep financial stocks from participating in what would normally be a favorable environment for them.